But for the timing, it's back to banking. SBI came out with a very steady set of numbers for the first quarter. Numbers were more or less in line with street estimates. Profits rose, net interest income remained flat on a year-on-year basis. Our colleague Ritu Singh caught up with the SBI Chairman, Mr. CS Setty, to discuss the quarter gone by and, of course, the outlook ahead in a fast-changing rate environment as well. Listen in to that conversation.
We are still sticking to 12% credit growth.
So which is not much of an upside from 11.6%, the rate that we're seeing currently.
Yeah, but we want to be, a little more balanced in that. In fact, I did say last time that if things improve, we may even reach 13%.
Okay.
But if you see this 11.6% growth rate, what we achieved is better than what industry has done.
Of course, that's 9.5% kind of rates. On the deposit as well, your guidance was about 10%. Is that something you maintain?
Yes.
And you believe the deposit repricing is done, so therefore margins which have shrunk in the quarter, what sort of headroom do you see, for further improvement, especially if RBI, maybe brings down rates further sometime in the future?
So the margin improvement is coming mainly the repricing of fixed deposit, which is likely to happen. In our books, normally it takes about 8 to 12 months for the 80% of the fixed deposit to get repriced. So that advantage anyway will come in. Number two is that the margin improvement on account of CRR cut. We almost will have 52,000 crores CRR.
Starting September.
Starting September. That means, earlier also I mentioned that the NIM trajectory of U-shape will still we are holding on to it.
Yeah.
It's a combination of the cost of deposits coming down and the repricing of retail loans becoming stable. At least till December, we don't see any further rate cuts. Which means that the retail personal loans, retail home loans will remain at the rate what it is today.
But it's a U-shaped recovery. It's not a,
it will be a U-shaped because there's a lag in terms of deposits.
So you'll be able to get back to or defend rather 3%.
So our exit NIM probably would be above 3.
A quick word on the asset quality as well, sir. Typically, we understand the first quarter does see a spike, but it's a biggish jump for you, from 4,200 odd crores to almost now you have 7,900 crores. Briefly for our viewers, where did this stress come from? And other pockets of stress that lenders have been highlighting, whether that is MSME, MFI, is there something you'd like to point out as well?
No, first of all, I think the comparison should never be with Q4.
Yeah.
You should compare with the Q1 of the previous year.
Which is more or less flat with little bit of a spike.
300 crores and in a book of 42 lakh crores is not a matter of concern. And also in the Q1 generally is the gross slippages. Right? As we go forward to become net slippages. For instance, from the 30th June till today, almost 14 to 1500 crores have been pulled back. In the slippages. So there's no great concern in terms of the asset quality. We have not seen any of the segments doing, in our book at least, that any stresses.
Okay, so improving margins, no asset quality stress, biggest bank, really helping, I think, take away some of the concerns that we've seen in some segments, and actually in Tier 2 banking more than Tier 1.